6.1, and we see the picture here with Snooki. Well, what is consumer credit? And we kind of start off going into the different types of credit. Credit, what it is buy now, pay later. You receive cash, goods, or services now, and you pay for them in the future. And there's a type called consumer credit, which is for personal use. Now, that is not just when we think credit cards, that is any type of credit. Any type of credit in which you buy now and pay later. So for loans, for cars, for college, mortgages, and they're not just from banks. They can also be purchased from retailers or merchants, such as if your parents may have a Macy's credit card. All right. So when you think credit, don't just automatically think credit card. Also think loans and mortgages as well. Now, just a few terms. Creditor, okay, that is the person who lends the money. All right. And debitor, so I personally have a credit card. Your parents have probably have credit cards. You may have a credit card. We are called borrowers. All right. So just main thing here, when we think credit, don't just automatically assume credit card. There's all different types of credit out there, and we're going to dive into them in this chapter and moving forward. So the good things of having credit, and specifically credit cards, just to note, if you're not sure of companies of credit cards, we have American Express, we have Visa, if we're a little unclear. But the advantages of having credit cards and loans is you can enjoy goods and services now, basically what it's for. People can enjoy the good of a car, the good of a house, college, and pay for it later. All right. You can also combine several purchases into one monthly payment by using credit. So instead of paying it in separate ways, just pay it all with credit. And you have one monthly payment that you have to make. It keeps a record of your expenses for you. It is safer than carrying cash. And we talked about that maybe the first week of class. Because once you lose cash, that's kind of it. You can't tell the bank, oh, don't let person spend that money. With a credit card, if you were to lose your credit card, you can cancel it or put it on hold. So it is safer than carrying cash. And by using credit, you can develop a reputation for responsible credit use. Will increase your credit score and give you generally lower interest rates and more opportunities for bigger purchases such as a car and a house. There are disadvantages, and you're going to see that with our True Life episode. It costs money. So to borrow money, it costs money, and that costing money is interest. All right, that's the cost of credit. It does not increase your purchasing power. Biggest thing here, you do not have more money. All right, just because you have a credit card, for example, you do not have more money. You eventually have to pay it back. And that's the trap that a lot of people fall into. So please remember that. It does not mean you have more money. There is a temptation to buy more than what you can afford, being that you have just this plastic card. We're still staying with the example of credit card. You have the temptation more to just swipe and swipe and swipe because you're not physically carrying cash. It's kind of like the out of sight, out of mind. If I don't have my cash right in front of me, it's out of my mind. I'm not as responsible. You have that temptation of not being as responsible. So there is that temptation to just swipe and swipe and swipe and then find out that you spent way too much than you would have if you had, say, cash on you. So there is temptation to buy more. You can have a difficulty of paying bills, especially if you use credit too often. And if you fail to repay and miss payments, you get a lower credit score and you lower your good credit reputation, which means interest rates that you have to pay in the future will generally be higher. And we'll see in the True Life episode, these three girls we're going to follow, they really lost their good credit reputation. So the types of credit. There's closed-end credit, which is a one-time loan that you'll pay back over a specific period of time in payments of equal amounts. Okay, it's a one-time shot. They usually have lower interest rates. All right, so this is a loan such as for a car, for mortgage. So closed-end credit is usually your loans. Open-end credit, I know it's hard for you to see in the slide here, is credit with a certain limit on the amount of money you can borrow for a variety of goods and services. So that is, you have a certain line of credit, meaning you have a certain max amount of money you can borrow, but it's open. It really never closes, and it's just long lasting. You can use it as long as you want. It's not like a car where you'll have a 10-year, 15-year loan, or a college bill where you have a 25-year loan, I should say, and the loan is paid off in 25 years. For a car, maybe paid off in 10 years, etc. For open end credit or with a line of credit, there's no end period. You just have a max amount of money that you can use, and that is it. And the perfect example for open end credit is a credit card. Loans, right? Going more into detail with closed end credit, okay? And these are sources of consumer credit. There are inexpensive loans, and that is from family. Usually, when your family gives you money, okay, very inexpensive loan, your parents and guardians probably don't charge you interest, or they might. Um, there's also medium price loans, and they come from commercial banks and credit unions that have moderate interest. All right. There's also expensive loans, and these are from finance companies and retail stores. So back to the example with Macy's, okay, that they offer their own store credit card, usually have a higher interest rate, but they are generally easiest to obtain. The expensive loans are usually the easiest to obtain. And then lastly, we have a home equity loan, or also known as a second mortgage. And essentially what that is it takes the value of your home and subtracts it by the amount you still owe, and whatever is left of that, that's what you can borrow on. So if you bought a house, if the value of your house right now is $250,000 and you only paid off $100,000 and you still owe $150,000, that remaining $100,000 you can borrow on that $100,000. All right, but most of the time they won't allow you to borrow that whole 100% of the $100,000. We'll get more into detail on this in class. I just wanted to start out so you can be aware. But when you miss payments on your mortgage, the lender can take your home. So it's never yours until you pay the entire amount off. All right. So the house is never yours until you paid it off in full. So always be aware of that with credit. It's never yours till it's paid off entirely in full. Now it's yours. Okay. It's still the borrower's if you still have loan payments to make. And then last slide for this section, open-end credit. That is also known as revolving credit. Right? There's no end period. The average card holder has about 9 credit cards. All right, very interesting statistic. There is no finance charge, or just another word for interest, if it's paid off within the grace period. Okay, so for example, my credit card, I have to pay it off the first week of June. As long as I pay it off in full within the grace period before, let's just say June 1st, I don't get hit with interest. It's when after June 1st, after my deadline, and I still have a balance, I didn't pay it off in full, I then get hit with interest. Okay. So when you have a credit card, you want to pay it off in full every month. You really don't want to just pay the minimum amount. Okay. The lenders want you to do that because they'll make more money off interest. But whenever you get, especially credit cards, and that's what we'll focus on, you want to pay the full amount off every month. So you have zero balance. And like I said, borrowers who carry over balance will pay the finance charge. All right.